Hey everyone, welcome back to the United Financial Advisors podcast. You have Brad and Brad here with you for another episode. This today we're going to be going over things that your CPA isn't going to tell you, and the difference between tax prep and tax planning, and how a CPA and a financial advisor can work in conjunction with each other to make sure that there's actually planning going on and that you're not scrambling whenever April comes around to try and find last minute deductions because you've already done your planning from May through December instead of waiting until March and April comes around.
Well, taxes and finances are intertwined so much. We need to be working with CPAs.
It's really the best opportunity comes whenever CPAs and financial advisors are working in the same room for the benefit of the client that they're serving.
Yes.
And we're going to specifically focus today on business owners because we find that those are the ones with complicated tax situations, but also the ones that can benefit the most whenever it comes to tax planning and then the conjunction work between a CPA and a financial advisor.
I'm a
But
big fan of entrepreneurship.
yeah,
Love it. Yep.
why is
Yep.
that?
It's just great. It's the American way, man. You're your own boss. Uh, there's pluses to that and minuses, but overall, bottom line is you're still the boss. And your success and failure kind of depends on you. So if you like that responsibility, then entrepreneurship's the way to go. I love it.
I mean, you and by kind of by relation, me, came from a family of people that I mean that's really all that
All
family
of
has
them.
done
Yeah.
for 3 generations now.
Yes. Except our short stint in the military, where people told us everything to do.
That's whenever
That
they
didn't
found out
go
they
well.
hated that.
Did not go well, but proud to have served, proud to have gotten out. Moving on.
But I mean, so your dad opened up a restaurant, and then now your brother, my uncle, runs that restaurant, and then we have another aunt and uncle, your sister and brother-in-law own a hydraulic store, and then their kids have
Three
businesses,
locations. Yeah.
3 locations, and then there's you, and mom owns a dance
Dance
studio,
studio.
and here
You
we
have,
are.
yeah.
So just on his side of the family, we've if you combine both my mom's side and my dad's side, there's about somewhere between 11 and 13 businesses or business owners. And so we understand the business owner archetype because that's all our
That's what we
family
know.
is. It makes Christmas very interesting because you have a lot of stubborn personalities in the room.
What?
A lot of people who wouldn't want to work for anybody else, then all come in the same room together and try to tell each other what to do.
Yeah, they all have their opinions.
They do. They do. They do. But first, so obviously Brad Sr. has been in the business for a little bit,
Senior.
in the business for a little bit longer. And so we want to start with kind of just a story of some business owners that planned successfully and then also didn't plan successfully. And we're gonna start with the negative first.
Oh, negative. Well, I've had some clients who started businesses and those businesses didn't go well. I've had one that emptied their 401k after they rolled it over to help their son start a business, and the business failed.
What
And
was the
then
business?
it was a lawn care business, but they had to buy the truck with the matching trailer and all new equipment, and to really wanted to start out with a bang and be seen, and it didn't work, and so he lost his all his retirement because of his son.
Hey, don't I haven't asked you to drain your retirement, so
No,
I feel
you
like
haven't.
I'm off on the right foot
Yep,
here.
yep. Well, I wouldn't. I'd say, well, sorry, son. So, I remember the analogy of the airplane. in the
Yeah, put your
oxygen.
oxygen
Yep,
mask
my
on
oxygen
first.
mask would still
Yeah.
be on. I'd be like, "Look,
Yeah.
man, I'm trying to help you, man." uh, um, but I've also had a client that did well with the business, but wasn't prepared to sell.
Okay.
The business did well, completely debt free, but had a specific person in mind or company, the way he wanted it to go, and that person never came to buy it. And so he ended up just closing it and liquidating the assets little by little. But it was a successful business, um, and they're doing fine. Just that it could have gotten more money another way if it wasn't kind of stubborn.
Yeah.
Um, could have sold it, had offers, but I was a little too particular on who he wanted to run his business instead of taking the money and run. Um, so that's a I mean, he tried to plan, but maybe planned too well, too much,
Hmm.
had too much into it. And then I've had several clients who've ran successful businesses, and someone came along and wanted to buy them, and they sold them, and they retired before age 60.
So is that the story of someone who kind of planned their exit too much? Was he a boomer by any chance? Was he a baby boomer?
Yes.
There's a reason I asked. So I was reading something about different types, just different generations of business owners, and I found something interesting was that so baby boomers, came into the world directly after World War II, right whenever the baby boom happened. And because there was a huge population growth, there wasn't necessarily the jobs there. And so they went out and they had to make their own jobs,
Hmm.
right? And so they built their own companies,
Did a
and
good job.
a lot of them did really successful because the US economy also at that time just was booming.
Hmm.
The US economy was booming, and maybe they had a good business idea and they really capitalized on that movement. But a lot of times the business that a baby boomer starts is the only business that they ever own, and they
Yeah.
own it typically for a really long time. And so if that's you, maybe you've owned your business for 20, 30, 40 years, you're in your 60s or 70s, and it's the only thing you've ever done. And so it's really for the boomers, it's their baby. It,
Hard to let it go. Hard to watch someone else take it. Hard to watch someone change it. Yes.
honestly, some business owners are more stingy about what happens to their business than they are their own kids, than they are their actual baby. But what's an interesting shift is some of our millennial clients are kind of going into business with the purpose of selling. So millennials had seen, and grown up, especially around the turn of the dot-com bubble, you know, but the successful people that exited out of the dot-com bubble before it burst, sold their business, started a new one, and then oftentimes went on and sold the next one. And so a lot of the times the wealthy people that millennials got to see weren't the ones that had one business and stuck with it forever. It was the ones that founded a company, sold, founded, sold, and then founded and sold again. And so a lot of millennials have tried to or are currently doing the same thing. Well, they'll start a business or buy businesses, and then they're less, their identity is less encapsulated in the business because they know that they're getting in the business to eventually sell it.
We just listened to one that bought franchises and sold franchises.
Exactly. It was a
Yeah.
guy at Seven Brew that he bought Planet Fitness. He bought in early in Planet Fitness, grew that up, sold to private equity, and then bought into Seven Brew, grew that
Sold
up,
it.
and sold it to private equity.
And now he's looking for another.
And now he'll and
Yes.
and he'll do it again because he just likes
Yep.
the game.
Hmm.
But boomers were playing a different game. They wanted to do the same job. They wanted to do it for a really, really long time, and a lot of them built very, very successful businesses. But we find that they have a much harder emotional time selling their business than millennials do. And
They
they're
have that
also
attachment
and
very
and
much.
that unfortunately that attachment is usually to their detriment because they have an idea or a price of what their business should be worth, and sometimes it's not worth that.
Yeah, but it's that attachment that got that business and made it successful. It made them
It
stay
is.
with it through the bad times because they have that attachment. And that's not a bad thing there, but at some age or some maturity level of the business, you have to kind of start to see the end and start preparing for it and preparing for someone else to take it over and change it or just close it.
Closing is not the way to go.
No, but I've seen
if you
more of that lately. I can't think of a client, but I've seen it around town and hear in the news of these businesses that are just closing. They're just closing. It's like, well, we're retiring, so we're done. So I'm like, you surely can't find a buyer at all, or you have,
even for pennies on the dollar.
yeah, at least get something, walk away with something. So
I don't know. We'll get back to a little bit of exit planning towards the end of this video. The next thing that we want to go into is kind of why CPAs actually don't do a lot of tax planning. Now, first, I want to say that there are CPAs that do tax planning. It's actually becoming a
yes.
lot more common, but I would still say the majority are tax filers.
Well, from our perspective, the number one complaint we hear from our clients is that their CPA doesn't tell them anything until tax time, and then they say, "Oh, you owe this much in taxes, but you can make these changes and maybe it'll be better next year." And that's the number one complaint we hear. So we can't throw them all, lump them all together,
Yeah.
and throw them under the bus, but it is the number one complaint we hear.
Say there are CPAs starting to do advisory services.
Hmm.
They're starting to do some fractional CFO services, and those CPAs are doing this tax planning, and they are doing a good job of it. However, if you're a business and you're paying a couple grand for taxes, you're probably not paying for tax planning, and so you're not going to get it. You're going to
Right.
get a tax filer because your taxes might take them 10, 20, 30, 40 hours. They can't they can't file your taxes and then also do tax planning for you for that same combined price. Their cost is too high. And so to get that tax planning from a CPA, you got to pay for it. A lot of people just kind of refuse to pay out of pocket.
They still look at it as to do my taxes
Right.
instead of all the planning that goes involved
Right.
with it there. So yeah, they don't see the full value of what they're getting for their money.
Right. Right. And so where we come in is doing lifetime tax reduction. And so we'll look at, okay, here's your income. What accounts can you contribute to? Can you do Roth conversions? Can you, take some deductions here? What other deductions can you get? And by doing that, try to run estimates of how much taxes will you save over the course of your life. And yes, the 401k contribution right now is $24,500. If you're a business owner, you're able to get more in through the business side, so you can get a higher deduction. A lot of people say, well, that's not enough. I need a much larger deduction. But whenever you really carefully place your money into tax advantage locations, the effect compounds again and again and again, year after year. And so in the end, we're usually able to save sometimes hundreds of thousands, sometimes millions, depending upon how far out we're looking. And it's just by placing usually the same money that they were already saving in a little bit different of a location.
I think I love entrepreneurs like right here, but I love saving on taxes like right there, right
I
there.
mean, everybody hates paying Uncle Sam, right? No
But when you
one.
can save a client tens of thousands of dollars in taxes, that's a pretty good feeling.
It is. It is.
Yeah.
And usually whenever we're talking about taxes, it's usually timing and location.
Hmm.
So can we take a deduction and then unravel that deduction and somehow save because of the timing difference? Can we put it into a different location and save on taxes because we're not having to pay them every year? We're able to defer. We're able to get a tax deduction, and so it's really the timing and location that we're going to use the most as our first kind of tools in our tool belt that we're going to go to help our clients save on taxes.
Location, location, location,
Yeah, yeah. And then the another way that we'll help clients kind of navigate is start talking really just basics with them about entity structures. So, what are you? Are you an LLC? Are you an S corp? Are you a C corp? Are you an LLC taxed as an S corp? Okay, so what does all that mean? If you're an LLC, so you're either taxed as a sole proprietorship if you own
which
the business.
stands
LLC
for,
is a limited liability corporation. If you're an LLC and you're the sole owner of the LLC, then your tax is sole proprietorship unless you elect otherwise. If there's multiple members, then you're defaulted to being taxed as a partnership. Then you get to choose S Corp or C Corp. The biggest difference with an S Corp is that you're required to pay yourself a salary. But everything outside of your salary as payments doesn't count as compensation. It instead just counts as ordinary income.
he likes talking taxes.
I do.
Just
I
saying.
do. But okay, so why is that important, right?
It's very important.
Very important because whatever is not your salary avoids self-employment tax,
Hmm.
which is a 15.3 percent tax that the government puts on self-employed individuals to make up for the FICA taxes that an employer would match with an employee.
Yeah, we've mentioned the word taxes in the last 2 minutes a lot more times than I like to hear. Making me itch. Oh, but yes, the a lot of people overlook that, and they go the simplest route of just being self-employed and being an entrepreneur. And it's not until later when they get hit with a big tax bill, they're like, "Oh no, what can I do different?" That's where the proactive planning come in. That
Yeah, you really so something that I do and he does, so he keeps his own books. So you have a good idea of where you're at in both income and expenses throughout the year.
right?
And so you don't have to be a tax preparer to get around April, and then you probably know, about where you're gonna stand. And then for me, I keep track of my income as well, and I keep track of my deductions, and I'll be able to see, okay, my income is here, my deductions are here. What do I need to make an estimated tax payment? Do I not worry about it until April? What's the situation going to be? And so by keeping track of your income and your expenses throughout the year, you can better predict what April is going to look like. But if you know that you have a crazy big profit, either be prepared to pay up or you need to do planning during the year. And that means not waiting until April of the following year. It means you got to do it right then and there while you're making the money.
So the good news for me and you is that you were a tax deduction, but then you graduated college and got married, but now you're on payroll, so it still helps.
Yeah, I still
Still
get a
helps.
tax
That's
deduction for
right.
me. You're
That's
welcome. You're welcome.
right.
I'm glad to help out.
I like it.
But the biggest thing, so I mentioned an S corp. I mentioned it. So a C corp. I'm not gonna go too deep in on because mostly
We
large
don't.
businesses
Yeah, we don't
are C
have
corps.
many C
Yeah,
corps.
no, but S corps, you pay yourself a salary. Anything other than the salary uh, doesn't get counted as self-employment tax. And then also the important thing is a reasonable salary is going to depend on what your job is, right? So if you are a specialized doctor, your reasonable compensation, or your reasonable salary is going to be much, much higher than someone who owns a hardware shop, which also means that you're going to have to pay yourself a higher salary. So an S corp might actually not be as powerful. Different CPAs will say 50,000, 80,000, 100,000. Well, it really depends on what is your job, what state are you at, and also
Yeah.
how much salary are you going to have to pay yourself? Because you also have to think paying a salary means you have to roll a payroll system. You got to keep better books. You have to, if you're even if you're an LLC filing as an S corp, it means you have to do the compliance of both an LLC and an S corp. And so there's higher costs associated with that. And so the tax savings really needs to outweigh the additional cost and the compliance headache that you're taking on. So before you just automatically switch to an S corp, you need to dig another level deeper and see and think, okay, what's my reasonable salary going to be? Do I actually have that much profit beyond that? If you're clearing $200,000 and you own a medical practice, S corp probably isn't going to benefit you that much.
Which goes back to our opening statements. The planning ahead is just so much better, can save you so much headache and taxes if you just plan ahead instead of just. And most business owners, maybe most, um, they're doers, they're
Right.
workers,
Hmm.
they're good at what they do. And they just dive in and do what they are good at and not stop to say, well, I need to do set up this way and do this for taxes and that and that. And he's like, that'll take care of itself. My dad was great at running the cafeteria, at running the the line and the cooks and the kitchen and all that. And it was great. I missed the food tremendously. The way it was a huge line of food. Now we're restaurant style, or my brother is, but the when it comes to the back office planning, it just he didn't take a lot of time to do that because everything else took so much time and to run the business. And so that's where people like us come in at. We help you take that time and plan for you and give you the advice that you need.
Yeah, and a lot of people get into business because they're like, oh, I do this thing good. I think I can do it better than someone else, so I'm going to go into business for myself.
Hmm.
Then they kind of forget about, well, you need to also be good at business. You
Yeah.
know, it's really great to be good at the thing you're good at, whatever that might be. It might be someone in construction, it might be someone that owns a restaurant, it could be owning a hardware store, or it could be a doctor. But you also need to be good at business
Just don't
itself.
ask me to help you with the restaurant. I'm done. Done.
Yeah, no, I don't blame you. I don't blame you. I only worked a summer in the restaurant. I think that was enough for me.
I wash dishes at home. That's
Yeah.
enough.
Yeah, that's enough restaurant.
That's
That's
right.
enough restaurant for me. And then also a lot of business owners will get caught up in reinvesting into the business, which is great.
Hmm.
You absolutely want reinvestment in the business, active gains. So think, owning a business and getting an active return because you're out there going and getting it is riskier, and thus you should get a higher return than the market. If you're doing a good job at business, and if the specific industry you're in isn't greatly affected by something out of your control. And those are a few really, really big risks that business owners typically completely overlook.
I'll go back to the lawn care business. It affected more than just the business when that business went down. It affected his entire retirement, which also affected his wife and family and have to go back to work. So if you put all your eggs in that one basket and that basket is gone, that's what you end up with. Nothing.
And I will absolutely agree that concentration builds wealth and diversification preserves it. However, there's a certain amount of concentration that is too much. And a lot of the business owners that we talk to, other than their primary residence, their business is 90 to 95% of their net worth.
One common type of business that we hear that a lot is cattle ranchers.
Yes.
They put all of it back into more cattle.
I would
Everything's in cattle.
I'd say hard asset businesses as well. So
Yeah.
construction businesses too. They go out and they buy more equipment so that they can get more jobs. Absolutely. There needs to be some investment outside of the business, not because it's going to get a higher return, but because it diversifies that risk away from the business that you're currently in.
Right.
Because whether or not you want to believe it, your business is not 100% in your control.
Unfortunately.
No matter what. And then
Unfortunately.
that really hurts because most business owners go into business because they feel like they do something good, they do something better than someone else, and so they believe that they can go out and kind of, create their own destiny, right?
And some extent they can, but there are forces out there that, like your own health. If your business depends on you and your health is gone, there's not really anything you can do about it.
Nope.
It's just it's just done. Or, you know, you go in for business, let's say you are going to go into the payphone business several years ago.
Which could have been really
It
good
could have
whenever it
been
was
good for a
happening.
while, but then cell phones came around, and there's nothing, and you either adapted or you just wiped out. And how many businesses can we look at? A Blockbuster. Um, there's others that they're just gone. So there are some things, but going back to my original statement of entrepreneurs, it still largely depends on you.
It does.
But you do have to prepare for the outside influences that are beyond your control.
Especially the more employees that you get, the more outside your control it becomes.
Yeah.
You're welcome. Welcome. I'm glad to help that.
Yeah. Next
But
topic.
yeah,
Move on.
yeah. Say the reason I bring that up is because whenever we talk to business owners about retirement planning, typically their answer is my business is my retirement
Yes.
plan, or I never want to retire, or
I'm gonna die doing
I'm
this.
gonna die doing
Yeah.
this. um,
Hear that a lot.
or alternatively that they just want to keep reinvesting inside of the business. And I think for a few years it's okay to reinvest pretty much everything inside of your business, but
Well, you kind of
after a
have to
year,
because you got to
yeah,
get profitable.
you got to get profitable. But whenever you get profitable, I would say, or at least 5 years in, you really need to start divesting away from the business. Not entirely, you still need to pour money back in,
Right.
but you need to have a portion of your income go into something not tied to the business that you're in. Not necessarily because we think it's going to fail, but because if that does happen, you don't want your entire life to be ruined. You don't want to spend 40 years building something that has no sellable value. That's unfortunately what some business owners do. They spend 40 years and the business at the end, no one's going to buy.
And a big reason that we hear people uh, say that they want to just continue to reinvest in their business is because that's what they know. They don't understand the taxes. They don't understand all the investment world or financial planning world. They didn't go to school for that. They do what they do. And so they kind of avoid, it's just human nature to try to avoid the things you're not comfortable with that you
They
don't
invest in
know.
what they know.
And instead of finding a trusted professional to help them, they just kind of avoid it and they just pour back into what they know.
Yeah, we see that. I feel like cattle ranchers and farmers are probably
That was on top of my mind
some
too.
of the
So,
some of the biggest ones, and that's a case of asset rich and cash poor
Yes.
to a T. You know, they might be a millionaire on paper, but they struggle to make ends meet.
Yeah, it's understandable. I mean, it's just human nature. You stick with what you know, and you kind of avoid things you don't know, you're unfamiliar with. But that's where companies like ours can be play a valuable role in your business.
Yeah, and so for retirement plans specifically, if we're dealing with, so we're going to stick to solo business owners first because there's a little more simple to understand. There's there's really two main options. One is a SEP and one is a solo 401k. So a SEP means a simplified employee pension. Essentially, your business pays into your retirement. It's up to $72,000 a year or 25% of your profit for that year before self-employment tax comes in. The big advantage to a SEP, self-employment tax free because it comes from the business and it's not a salary deferral.
It's only from the business.
Only from the business. The individual can't contribute.
Correct.
It can work with more than one employee, but it kind of breaks down after a while. It gets too costly and confusing, and there's better options out there.
And you're not under any obligation.
That's also
That
true.
that's important, especially starting out with a new retirement plan. Business owners are skeptical, or I guess more antsy about, well, what if I have a bad month? What if I have two bad months? What if it's a bad year and I'm locked in to have to contribute to this retirement plan? With a SEP, you're not. You can wait till the end of the year. Say, oh, it's a good year. Let's dump a bunch of money in there. Or you can do every month, or lots of flexibility in a SEP.
Yeah, with a SEP, usually I say have a very small fixed amount that you contribute, and then at the end of the year, put however much more you need to. Just because I find a lot of people forget about it if they're not
Yeah,
doing it every month. And so, at least at the very minimum, something is going into the plan.
but if it's a bad year, you can stop contribution and just skip that year.
Absolutely.
Go to next year. But sure, anytime you're contributing systematically, it's it's kind of the out of sight, out of mind. You forget about it, which is the best way to invest, is kind of forget about it and let it grow. But it always brings business owners comfort to know that they have a way out, or they can just, they're not obligated. It's that fear of having to do it
hmm
is what they don't like.
The fear of fixed costs.
Yes,
It's okay to have a
I
one-time
understand that.
expense, but a fixed cost is something you want to avoid because if
Yep,
income goes like this, fixed cost eats into all of it.
right. And you always, as a business owners, you always have people come in telling you that this is the next greatest thing to buy or subscribe to or purchase or something like that. And so it gets overwhelming. So I understand it. But when you're talking about setting money aside for yourself, though, that's more important than all the other things, really. You need to set aside money for yourself and do that systematically and let it build.
And then a solo 401k combines both the salary deferral, so you're able to, especially if you're an S corp, you have to pay yourself a salary anyways. You can defer that inside of the 401k, and then you can also contribute to the business. Same contribution limit of 72,000. The business can contribute up to that 25% of profit, but then you're not limited on your salary deferral side of that 25% of profit.
Now you get to the best of both you get the best of both worlds. You're the employer and the employee contributing to the plan.
Yeah, and they're usually if you're in a S corp and you're paying yourself a salary and you're on payroll, then you have to do that every month. If you're a sole proprietorship or even a partnership, you can kind of just contribute whenever. You can make
Yeah.
a one lump sum contribution, and that can be it, man. So there's a ton of flexibility in a solo 401k. And so that's another reason why we see a lot of business owners enjoy it is because of that flexibility and being able to kind of customize it depending on how good of a year that they had in the business.
So recent story of I was getting a haircut. I
Okay.
haven't told you the story yet.
Okay.
You know where I get my hair cut.
I do.
And the barber starts telling me that she's going to start setting aside money. I said, great. She goes, I'm just going to open me up a 401k and da 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 da. And I was like, why are you going to open up a 401k? She goes, because that's what my mom said I should do. I said, is your mom an investment person? She goes, no, she's pretty smart. I said, okay, I don't doubt that. I said, but you know, how much do you and your husband make? And what does he do? And does he contribute to a retirement plan? And how much money are you planning on putting in there? Can you put in more than what an IRA maximum contribution
Yeah.
is? Or are you just going to talk about $50 a month? I said that makes a difference on what plans are good for you. And then do you need tax savings? Do you want the flexibility? I mean, everybody needs tax savings, but do you want the flexibility of like a SEP? Or do you want, or is your income steady enough where you could do every month or every week or, and by the time I finished my haircut, she was just ready for me to leave.
Get this guy out of here. Too many questions.
She said, I said, do you want me to give you my card? She said, I'll find you. I'm just saying it's more complicated than just, hey, my business is at a point where I can set aside money. I'm just going to open a 401k. I said, you can go to other financial places and say, I want to open a 401k, and they'll just open you up a 401k because that's what you want.
It's true.
But I told her what we do is we sit down with you and ask you these questions. Like, because we want to find the best fit for you. We don't want to put you in something like you have to contribute X amount of money every month, and you can't really afford that.
So even the cheapest 401ks are going to have monthly fees.
Yes.
And so if you're doing $50 a month, there's and you're getting 6 or 10 or $18 in fees every month. That's horrible.
Even if it's 400 a month, why pay for 401k?
Right, because you could just go into an IRA or a SEP or a combination. You could do a SEP and a Roth.
Yes.
There you go. That's all you really need. So until you get over those amounts, dealing with a lot of this complexity is kind of it's just not worth it. So whenever it's really whenever people are contributing 7, 8, $1,000 or more a month. I mean, sometimes we have people contributing, you know, several $1,000s a month on average, and then some months they'll contribute 100 grand, 200 grand, 300 grand. And so not to a 401k, but just to other funds.
Mm-hmm.
And that's whenever it gets complicated. So if you're dealing with, I'd probably say less than $500 a month, then a 401k is probably not what you're looking for,
I agree.
especially if it's just starting out. It's really whenever that contribution starts to get really big or you're able to afford a much larger contribution that the type of plan is going to really change depending upon your situation.
So you want me to tell you the rest of the haircut story?
Sure.
Because we
Go.
talked about you.
Oh, great. Great.
No, she saw my name on another barber's list to get their hair cut. And
She
she
get a
thought
little
it was
jealous.
me. Yep, she thought I'd changed barbers. I said, "You were probably cussing me out, weren't you?" She goes, "I didn't say anything. I was just wondering why you're going." I said, "Yeah, whatever."
She said, I didn't say anything. I was just a little offended.
If I was nearby, she probably would have hit me. But yeah, it was funny.
Okay.
She said, "I saw Brad Lewis. Well, why is he over there? Why is he?"
I think they said the same thing. So for context, we get our haircut in the same place, but not by the same person.
Right,
And so, but they can see who all's booked and
right. So she saw Brad Lewis with another barber.
just a little offended.
Yes, yeah.
I get
So
it. Earlier we were talking about ranchers and farmers, and I used the term asset rich and cash poor.
right.
How do we keep people from being cash poor?
Well, before I directly answer that, another reason why sometimes they are is because, especially ranchers, and I can think of some other people who they're sold on the idea they got to buy big equipment and things to get the depreciation, and
Yeah.
then so they'll spend all their extra money on that. On it, and the word depreciation is tells you that it's going to be worthless at some point. Whereas putting money into a 401k or just setting it aside in something else that's going to appreciate, and it's hard to get through to them that you need to have this appreciating asset. You don't have to go buy more and more depreciating assets
Yeah.
if you don't need them.
Right.
Obviously, if your business needs them, that's one thing. But if you're doing it just for the tax savings, we have much better options, and you'll actually get you that money back and then some at
Right.
a later date. So if we can get through that mentality, then we can get them on the track to setting money aside.
And people get more comfortable with the market the longer they're in it. But the hardest
Right.
part is that first little toe in the water.
Yeah.
It's like it's so hard to get them to go from not being in the market at all or having a very small portion of their net worth in the market to stepping more aside. And if you have $1 million net worth and you have $10,000 in stocks, you don't have any diversification unless those hard assets are diversified between cattle, real estate. Then you have some. But it has to be a sizable portion of your net worth to do its job. Because then if it's not, then you're not really diversifying from anything. You're not actually hedging the risk. It's just kind of some play money that sits there.
While you're talking, I'm just thinking of all the people that I finally got them to put their toes in the water, and that first month the market goes down. It just seemed like every time you get some money to say, let's just try the market, and then boom, the market's going to have a bad month that month, and or that quarter, and they get their first statement and they're calling me, and they're like, just give it a year, give it a year, and if you're still unhappy, we can look at something else, and the market usually comes back up, but.
Yeah, and the market's been doing great ever since really 2022.
Yeah, but every time I talk someone into it, it seemed like that 1 month. That's the one that's gonna have a shaky time in the market.
So now you can directly answer my question.
What was the question?
How do we help keep people from being cash poor?
Well, I was sort of answering it by getting them out of that mentality that they have to have more and more hard assets or depreciating assets, and how important that a 401k or a retirement plan of some sort is to them. Show them the benefits and the value of the tax deductions of those plans, and show them how it's going to grow and be there for them when they retire. Another thing is, what if there's unexpected death and their family has a lot of assets, but they don't have a lot of cash to deal with? So that alone should make you want to make sure you have some liquidity in your estate, in your business, so that things can continue and your family has time to either sell or, uh, keep it and pay the bills, and without having to sell for pennies on the dollar because there's
Yeah,
no cash.
yeah,
Was there something specific more you're looking for on how we get them into cash? And
yeah. Like how do we help them manage cash? How do we use non-qualified assets to get them invested in the market, but still be accessible, you know, accessible wealth, not just retirement assets.
right, so I was talking about retirement plans, which does lock up the money, and that also, you know, business owners don't like. limiting their options. They always like to have options, always like to be able to, can I get the cash if I need it? That's what I really need to know. If I really need it, can I get to it? So non-qualified accounts or non-retirement accounts um, provide that liquidity. It's like an extended savings account. You actually should have a savings account, but then we have investment accounts that are non-qualified. You can put unlimited amount of money in there and take the money out whenever you need it. But if you don't need it, you just let it grow, and it's going to grow over time much better than, sticking it under a pillow or leaving it in a savings account.
or CD.
I was gonna let you say that. You're messing with people's sacred ground there when you say
And
CD, Randy.
I'm sorry, but CD is probably the most oversold financial product in existence. So I
The opinions and views expressed at both sides of this table do not necessarily express those. I don't like CDs either, but um, for some reason, people are very intertwined with their CDs. They have
they are.
very emotional,
And we do
but
CD management for people that really want
we
CDs,
do.
begrudgingly.
It is.
They say we want a CD, we say, you sure? Okay, yeah, we'll do a CD. And the reason is
They say they want a CD. I said, all right, I'll set you an appointment with my son.
so the reason is there really are better options. And so it might yield a little bit less, but I even prefer money market accounts over CDs. It might be about 0.5% less, but it's completely accessible and liquid. So, you know, a CD, I feel like you give up so much and get so little in return. Yes,
But
you can
but
get to it
but
if you need,
FDIC.
and I also think FDIC. I might be treading on heavy this might offend some people, but I also think FDIC insurance is overstated, as in its importance sometimes. So
I agree.
and there are really good reasons for FDIC insurance. Absolutely. A lot of people, especially so we're in Fort Smith, Arkansas. So most people actually bank at local or regional banks. And I would say, especially at local or regional banks, it's pretty important for you to have FDIC insurance and to try to not go over that limit because it's much more likely that smaller regional banks hold more risk on their books and are much more likely to go under if something happens in the overall market and they don't have the liquidity that they need.
We're going down a rabbit trail on this.
A little bit, yeah.
So
But larger banks, the U.S. government has basically said if you're big enough, we'll just bail you out.
they've proven that.
So
There's a track record here.
if you're too big to fail, then they'll just go and bail everybody out.
Maybe one day we'll be too big to fail.
Maybe so. Maybe so. So, but even FDIC insurance, if it goes under, if the bank goes under, then you still don't have immediate access to that money typically.
Right.
But most of the time, another bank will come in and buy the other bank out.
True.
But insurance companies in
They
2008,
hardly ever fail.
yeah, they hardly ever fail
So,
because they don't hold a lot of risk on their books. And even through market downturns, there are a lot of insurance companies that have been around forever. I mean, basically as old as the United
I mean,
States.
they're so conservative, they still using fax machines.
Yeah, yeah, we
We
would know. We would know they're
wouldn't
hard to
have
get
a
a hold
fax
of.
machine if it wasn't for insurance companies and annuity companies.
They're slow,
Mm.
but they're steady.
Yes,
They're very
they
steady.
are. They are.
And so the reason I say that FDIC insurance is overstated in its importance is that if you're it's more important that the institution that you hold your funds at is very well capitalized. That's more important than the FDIC insurance. Because even if there is FDIC insurance, Yes, you'll get your money, but it might take you a long time to get to it. And what we find a lot of the people that we work with is that they're over FDIC insurance limits.
But if you want it, we got it for you.
Yep, yep. Put it
We'll do
in,
it.
put it
We'll
in
do it.
those CDs, and then you also have SIPC insurance, which goes to about 500,000. Um, and a lot of people are over that. Anyways, what's interesting is that people are typically less concerned about SIPC insurance and much more concerned about FDIC insurance.
Yes. So all you hear is FDIC.
But it's the same risk. It's only if the institution goes under.
Hmm.
So whenever we talk to business owners about selling their business, sometimes we need to figure out what's the number that's in your mind that you would sell the business for today. Then we want to look and see if that's actually reasonable and work backwards and see how they got to that. Would you agree that a lot of business owners kind of have like a number in their head already?
Yeah, yeah. They'll have a high number of to get me to be able to walk away from my business. I have to have this, and it's nowhere near really what the business is worth, but it's what is worth to them to walk away until they reach an age or a point where they're not happy anymore, or they don't like it anymore, or they just need to retire. Then they can bring it down a little bit.
So most businesses sell for the D's: death, disability, disagreement, divorce, disinterest. So most of the business owners that we talk with have one of those, and that's their primary reason for selling. Unfortunately, most business owners aren't choosing their exit; it gets chosen for them. And the way to avoid that is to proactively plan and exit before you have to. Exit before it's
Just
not your
hard.
choice. It is,
It's
and
hard.
and especially so we've talked a little bit about valuation. So small businesses, depending on size, can get bought for anywhere between 2 to 8 times their profit or their EBITDA, depending on the size of your firm. Do you have management in there? How much are you intertwined into the daily activity of revenue generation in your business? And the more important that the business owner is, the less the value of that business will be.
In which lots of businesses depend on the one owner.
So, really, if you are the business, you don't have a sellable asset. And so you need to take action now to get out of being the most important one in the room.
We visited a business not too long ago that was on their property, like their house was next door. How do you sell that? Are you gonna
It's
sell
also
your
in
you're gonna sell your house with it?
it was also in the
So
middle of nowhere.
yes. But the work from home business is fine as long as you don't want to sell it, unless you plan on selling your house with your business.
I would
No one's
say
gonna
in
buy
that
it.
case, that's true because their business was really asset heavy.
Yeah.
But if you have like a virtual firm, I'd say that's almost the ideal business to have
Yes.
because
Yes.
then that means
I
you
was
can have
talking physical
yeah,
business. Yes.
yeah. If you have like a computer work from home situation, it means you can sell to anyone across the country and
Yeah.
they can take over, and that's like ideal situation. But a lot of people don't do that, and then they also overstate the amount that they're going to get, and then also they overstate the amount that's actually going to land in their hands on closing day.
And they failed to think about the taxes, subtract the taxes from that.
Yes. And so taxes can play a huge part in how much you actually get at the end of the day. And so asset sales can typically lead to a capital gain that you get, or stock sale can lead to a capital gain. But if they're buying inventory or even accounts receivables, those all count as income. If they're paying a consulting fee, which this is actually something that we hear probably most often, is I'm going to sell my business to a family member and then I just want to charge a consulting fee, um, be on as a W-2 employee forever. W-2
Mm,
is but
mm.
W-2 is one of the worst ways to be compensated from a tax situation because you have no flexibility. So, and sometimes, although it hurts, it's better to sell and to not have the control so you can go out and be retired and enjoy your life instead of grasping onto to your business.
Yeah, when you talk about that, the emotional part plays a lot bigger role than people want to give it credit. And like you said, it's their baby. Even if they haven't had it for 30 or 40 years, it's still what they started from here, whether it was they bought it or they started it and they made it grow to here. It's still their baby. So it's still an emotional attachment, and you have to process the sale and the exit to where you're emotionally ready to just let it go and then take the money and run if you can.
Yeah,
Because
yeah.
I also have several clients who have sold their business and they've agreed to stay on for a year or two, and they
Hmm.
don't really make it that year. Usually, maybe 6 months into it, they're kind of going into work late, leaving really early, taking long lunches, and the owner's like, "Okay, you can just go," because their motivation's gone. They're just there because they're contracted to stay that long.
Right.
So if you got you got to take care of the emotional part, let that process, and then talking to us before the sale is important as well
Yes. Yes.
because they're still planning on the exit, and you know like some other situations I could think of where they own the land in the building and they could have 1031 exchanged it
So
and
1031
saved
exchange, you
it.
can defer all the taxes so you don't have to take any capital gain taxes from that.
Right. So they made enough money off of the business that they didn't need the money from the land and building. They could have just 1031 exchanged that, saved a whole bunch of capital gains tax, and then had greatly reduced their overall taxes. But they came to me afterwards and said, "Well, I sold my business. Here's the check. What do we do with it?" It's like,
Yeah, you really want to rope in all your advisors, your whole team to what you're trying to do before it happens. And so people can
yes,
help you avoid some really big missteps.
please,
Potentially, I mean,
please.
just that one case probably would have saved them what, 20, $40,000
Oh
in
yeah,
taxes.
yeah, like 40, $60,000. Yeah.
That's not chump change.
No, no, I take that.
Yeah,
I get that
yeah.
bonus.
I would yeah, I would take that too. And so also a typical structure is not going to be all up front. So if you hear about a $10 million exit, the likelihood that they got anywhere close to $10 million
Mhm.
on day one is about a fat zero. Maybe a little bit more than that.
Which they wouldn't want that.
Right, because it would be huge tax in one year.
Yeah.
But what happens most of the time is that someone comes, they have a little bit of upfront cash, they have a little bit of debt they're coming with. So usually that's all upfront money. And then they also have a seller's note. And the seller's note or that portion could be a revenue sharing agreement, but usually you have to stay on for a little bit after. It could be 6 months, could be a year, it could be 2 years. And so it's not, hey, I sold my business, I'm riding off into the sunset, and I have $10 million if you exited for $10 million. It's usually that amount's going to get paid out to you in the course of 5, 10 to 15 years. And so, you know, having an idea of that before the day actually comes so you're not so disappointed whenever they say, oh, this is going to be in a seller's note over the course of many years. That's normal, completely normal.
And the planning comes in again, not only the tax savings on the sale, but let's say it is just a 10-year payout. Well, hopefully you're going to live longer than that. So you need to plan how much can you spend of that. And so you still have money for the rest of your life after that.
Right.
You don't want to go from making $1 million a year down to Social Security. It's the
That
best
would not
way.
be good.
So
Yeah,
planning is a big circle back to where we started. Planning is where it's at. You've got to
that's
plan.
true.
You need
That's
some
true.
planners.
So if any of this sounded like it was pertinent to your situation, whether you're a business owner just starting out and you need to start up a retirement plan, or you're someone that's looking to exit within the next couple of years, where you already exited, both Brad and Brad here are available for your conversation. We have free consultations that we give to anyone, and then we want to see if there's a fit, if the relationship between us can go farther than that one meeting. And so if you're interested in that, there'll be a link in the description down below. Also, please like and follow. We'll be going over more business stuff like this later on, and then also dipping into retirement plannings, equity compensation, lots of other topics that we'll be going over together. And so, do you have anything else that you want to cover?
Well, business owners like the word free, and you mentioned free consultation
I
there.
did
So
mention free
that's good.
consultation.
Yeah. Yeah. We like it.
I like it. Okay. Thank you.
Thank you.